you to know about this. This is not something you need to panic about, but you do need to know about it. When we think about the price to earnings ratio, we think about how much we're paying for these companies. We have to acknowledge the price is rather high. Frankly, we need to take risk seriously. Welcome to Life in the Market. My name is Tim Russell, and today is Monday, December 1st, 2025. Well, we have a special episode of Life in the Markets for you today. I wanted to discuss something that's been a growing area of concern for me and for many others as we look at the financial advisory space, looking at markets and investing. And this is also tied to one of the biggest trends in investing over the past maybe 10 to 20 years. And that has to do with the growing interest in allocation towards ETFs, exchange traded funds. Now, an ETF is just like a mutual fund in a sense. It is a single investment that you buy that is divided up in many different companies. It holds many different corporations in it. It allows for diversification and allows for low-cost access to the markets, and you get what the market gets. You get to participate in the market growth. So specifically, with regard to ETFs, there are passive index ETFs, and there are other active strategies. And the passive market has gotten such a significant share of the flows that are going into investing in ETFs that has now caused at least some cause for concern that I'd like to share with you. This is not a warning. It's not saying you shouldn't invest in them. This is something you need to be aware of because it may influence how you think about and how you allocate towards certain investment classes. Now, specifically, the three largest ETFs in the entire world are all based on one index. They are based on the S&P 500. That would be the VOO, the IVV, and the SPY. These three holdings, these three ETFs, in and of themselves alone have about $2.2 trillion worth of value in them. So there's a lot of money that's flowed into this segment. Now, they are passive. Passive means that there's no investment manager really involved in these. It's simply buying whatever is in the S&P 500. From one perspective, investors love ETFs because they provide diversification, generally speaking, and they're generally lower cost, and they generally have better tax advantages than their mutual fund counterparts do. These things are obviously part of the reason why ETFs are growing in their share of portfolios. Investing in these ETFs are a great way of getting what the market provides. You are able to get the kind of return that the overall market gets, and you don't have to worry about your particular fund underperforming. If you buy the S&P 500 index fund, you generally get what the S&P 500 gets. So I understand why it's attractive for people to allocate towards the S&P. It's really hard to beat it. Today, I'd like to consider one of the benefits of investing in the S&P 500, specifically the benefit of diversification, and share with you that maybe the S&P 500 isn't quite as diversified as we think it should be. It's true that the index has about 500, technically it's 503 companies in it. So 503 people or three companies, you would think that they would take the money in the S&P 500 and divide it evenly between those 500 or so companies. If that would be the case, you would have about 0.2% of the S&P represented in every single one of those 503 companies. But that's not the case. That's not the way that the S&P works. You see, the S&P 500 is a market-weighted or a cap-weighted index. Now, what that means to those who are not initiated is that the larger your company is by market cap, market cap is simply adding up all of the available shares times the price per share. That tells you how big the company is, how expensive or how valuable is Walmart or Amazon or Apple. That tells you its market cap. So if you look at all of the companies in the world, all of the companies in the S&P 500, the larger your company is, the higher the allocation it is towards the S&P 500. What that means is that rather than providing true diversification, the S&P 500 concentrates nearly 40 cents out of every dollar, 40% of its value in simply 10 companies. These are the 10 largest companies in the world. In other words, these companies are controlling the kind of performance that you see in the S&P 500. There are a couple things that I think are helpful to note here. Just 10 years ago, those 10 largest companies are not the ones today, but the 10 largest at that time, 10 years ago, that only made up 17% of the index. Within 10 years, we went from the top 10 companies representing 17% of every dollar invested to today, it represents 40% of every dollar invested. That is huge. What a huge shift within the overall market. So you may wonder, what are these companies? What are the companies that make up the 10 largest in the S&P 500? Well, they are these: NVIDIA, Apple, Microsoft, Alphabet, Amazon, Broadcom, Meta, Tesla, Berkshire Hathaway, Eli Lilly, and in some cases they look and they say maybe it's JP Morgan Chase. Eli Lilly and Chase been popping back and forth past each other over the last couple days. These are the companies that are driving all of the performance in the S&P 500. First, we have to acknowledge that these companies are really well-established names, as opposed to the back in the dot-com era, the 1999, 2000 era, where you had companies that had no revenue, had no profits, barely had an idea, that just had a maybe .com at the end of their name. They got billions of dollars in valuations. That is not what we're facing today. Every single one of these companies have been around for a long time. They're very profitable organizations. They're providing great value to society. And that, frankly, betting against these companies and against their success has been a fool's errand over the last decade or so. These companies are successful for a very good reason. So don't hear me say that these are bad companies, that you should not invest in them because they're somehow necessarily unsafe. However, I think we do need to count the cost and consider risk. Now, the second thing I want to say is that almost all of these companies are tied directly to the artificial intelligence bubble that we do see emerging right now. And that's why I want to say pump the brakes. These companies are not bad, but there is a growing AI bubble, and these companies are tied to it, causing it in some ways, benefiting from it in many ways. And because of that growing bubble, the growing risk associated with that is not diminishing, and it's increasing. We see that these companies are investing in AI, creating the AI infrastructure, or doing the kind of work that is needed for the AI, artificial intelligence, to have its heyday that we're seeing today. Because of artificial intelligence, in part, that has actually fueled some of the growth that we've seen in these companies over the last couple of years. The third thing I want you to notice is that the price of these 10 companies is by no means cheap. When you measure the relative expensiveness or cheapness of the market, we look at something called price to earnings ratio, a PE ratio. And PE is essentially another way of saying, what is the amount or the stream of earnings that we're paying for? How much are we paying for it? So by historic averages, if we're looking at the S&P 500 going back to 1996, the average price to earnings ratio, get this, was 16.8 times earnings. So you're paying 16.8 times the earnings of the S&P 500. That's what it was priced at. If, however, we simply look at the top 10 companies and we consider what is the price we're paying for these 10 companies, it's not 16 times, it's 30.6 times. The price to earnings ratio is so much higher than its historic average has been. It is creating somewhat of a cause for concern. By the way, if you look at the S&P 500 and we just strip out the top 10 companies, instead of having a price to earnings ratio of 30% or 30 times, the price to earnings ratio is a mere 19.4 times. So yes, even by an objective measure, the S&P 500 is relatively more expensive than it has been in prior periods. This is simply just, I want you to know about this. This is not something you need to panic about, but you do need to know about it. So when we think about the price to earnings ratio, we think about how much we're paying for these companies. We have to acknowledge the price is rather high. So what am I saying? Frankly, we need to take risk seriously. It could easily be that we confuse strong market performance with no risk, right? If the market's just year after year after year putting out 20% returns in one calendar year after another, you tend to think that's the norm, that risk and downside volatility is not the normal thing. And I need you to know that that is not the case, especially with a growing AI bubble. We will see some pretty sharp downturns. I'm not calling for a specific time frame. I'm not saying it's going to happen tomorrow. It might not happen next week, next month, next year, but it is coming at some point. We will have a correction. And my concern is that the things that are so highly valued today are going to be some of the first things that are sold when things start to become uncertain. So take risk seriously. So what does that mean that you should do? That's a really good question. The answer from my perspective, I would have you just know this. If you are a client of the Life Financial Group and you're invested in one of our biblically responsible investment portfolios, we're trying to minimize and avoid investing in companies that profit from or manufacture tobacco, alcohol, casino, pornography, and abortion. With those things excluded from the portfolio, the reality is we're naturally going to be avoiding some of those larger names, and certainly the concentration of the larger names that we're seeing right now inside the biblically responsible portfolios, just by the very nature of the things that we're trying to avoid, pornography in particular, and some of those other factors. So if you are in a biblically responsible portfolio, we're already doing some of the work necessary to dial back the exposure that you have towards this growing bubble. I would tell you, if you're allocating heavily towards S&P 500 indexed passive strategies, large cap passive strategies, I would encourage you to consider diversifying. Now is probably a good time to move down into the mid cap to small cap category. Don't avoid large cap, but allocate a little bit more there. Allocate a little bit more towards international. Use this time to refill your cash cushions, put more money perhaps into bonds. Not that I'm predicting another, bear market per se, but we will at some point go through one. So now is a good time to make sure that your risk level's right and you have adequate cash reserves on hand. If you want to know if you're positioned properly for heading into an AI bubble bursting or some other kind of scenario, well, again, we can't predict the future necessarily. We can just look at trends and try to use some wisdom here. We can help you analyze where you're at and what you need to do to make sure that your investments are aligned with your values and with your risk tolerance. So reach out to us at thelifegroup.org. You can sign up for a stewardship review there, and we can help you make sure you're an even better steward of all of your assets. So I hope with this you are encouraged that we are doing things. There are things that can be done to mitigate some of the risks. And at the end of the day, we don't trust in me. You don't trust in some pundit on the computer telling you what you think you ought to do. We trust in the Lord. He is good. He is God. He is on the throne. So when you are worried, when you are anxious, remember what Philippians teaches us. Philippians 4, verse 4 and following, rejoice in the Lord always. Again, I say rejoice. Let your reasonableness be known to everyone. The Lord is at hand. Do not be anxious about anything, but in everything with prayer and supplications with thanksgiving, let your requests be made known to God, and the peace of God, which surpasses all understanding, will guard your hearts and your minds in Christ Jesus. Let that be the anchor of your soul when things become uncertain and unknown. Your Lord knows them all. He is still on the throne, and He has promised to meet your needs. Trust Him. You'll be grateful that you did. Until next time, take care. God bless. Be safe in the markets.
The topics discussed in this podcast are for general information only and are not intended to provide specific investment advice or recommendations. Investing and investment strategies involve risk, including the potential loss of principal. Past performance is not a guarantee of future results. All information herein is from sources believed reliable, but is not guaranteed for accuracy or completeness. The team assumes no liability for any errors, omissions, or actions taken based on this material. Information is as of the date stated and subject to change without notice. Securities and advisory services offered through Genius Wealth Management, member FINRA and SIPC.